sort of as you go through private equity, as you know, a lot of it is tribal learning. You look at pattern recognition and you see the same things over and over again. And sometimes they change, right? Because new things happen, like technology. And so you have to adjust your investing and your expertise to doing that.
Hi, this is Abhilash Jayakumar, the co-founder and managing director of Trust Vista. On today's Trust Vista talk, I have the privilege of being joined by Carty Chock, co-founder and partner of ClearPoint Investment Partners. ClearPoint is a lower middle market PE firm focused on business services and financial processing. Carty, thank you so much for joining us today.
Thanks very much, Abhilash. I'm very happy to be here.
Before we talk about ClearPoint, it's a business you started now 9 years ago. You spent a long time at other PE firms and started your career at JP Morgan, a couple decades ago. So before getting started at JP Morgan, I saw that you went to high school in Hawaii. And this is interesting to me because in a pandemic, when everyone's talking about work from home and you can be from everywhere, I have to tell you, I gave it serious consideration about moving to Hawaii. And the first thing my wife said, I have a 2-year-old, she's like, where will our son go to school? And I was like, oh man, you just busted my bubble. But Punahou School is obviously one of the top schools in the country, certainly in Hawaii. Can you tell me about how you moved from Hawaii into Wall Street and why you haven't gone back?
Sure. So as you've done your research, I'm just a kid who grew up on an island. My background is my ancestors, they were immigrants. They immigrated to Hawaii in the early 1900s and worked in the agriculture industry. My father was the first one to go to university. He went to school in the middle of the United States in Omaha, Nebraska. And I, as you mentioned, went to Punahou High School. Punahou, also from kindergarten. It is a wonderful place. I would highly recommend growing up in Hawaii. Not only do you have the ability to get a great education during most of the day, but you still go to the beach in the afternoon. And the weather's wonderful, food's great, people are very friendly. I think anyone would really appreciate their time there. Punahou was a great training ground for me. As you know, there's some pretty interesting people who went to the school, but I felt very well prepared to go to university. And I originally thought I was going to be an engineer. And so I went to the University of California at Berkeley to study industrial engineering and operations research. I thought that was going to be the be-all, end-all. I was in Silicon Valley at the time. Back then, Silicon Valley was producing hardware, not software or social media or internet things. And I thought I was going to be some form of chip engineer. In fact, one project I did was for a company called Silicon Graphics. And I thought I was going to be working there. Or I did another project for Chevron. I thought I was going to be a process engineer at the time. But I think what really changed my education, or at least career path from my education, was working at a power plant in Hawaii one summer. I got a great job as an intern, and I was responsible for calculating electrical loads all over the island and figuring out where you need to put more power or draw on more lines. And I would get into the office by 8 o'clock in the morning, and by the time 4 o'clock rolled around, everyone was going home. And I realized, even though these were nice people that I was working with and working for at the time, this wasn't what I wanted. I didn't want an 8 to 4 p.m. job. But when I got back to school and I decided where I wanted to work, someone said, hey, you should really think about looking at these finance jobs. You could trade your analytical, technical skills for some knowledge in finance. And I said, hey, that sounded pretty good. And a friend of mine, she, took a job at this company in New York I didn't know anything about. And I interviewed there, and they seemed to like me and I liked them. And so all of a sudden I ended up working for Goldman Sachs. And I had never been to New York before. So I think that was a pretty good transition. And I have to admit, it was a very interesting time. I got to Wall Street in 1989, And in my analyst class, there were very few minorities as well as women. The only minorities really were from the foreign offices, like from the Tokyo office or from the Hong Kong office. And so it was a very interesting time in Wall Street. And there, at Goldman, you really had to prove yourself. And I felt like both Punahou and Berkeley prepared me extremely well, both from a technical and analytical side. And I ended up writing a lot of financial models for them, and also thinking of ways to use data differently. Back then, we did a lot of research on CDs, if you could believe that, or books. And so one of my projects before I left was taking an Oracle database and sucking in all of this information and making it easier to present the financial statements for companies. And so while I traded these technical skills, they trained me on finance and marketing and making me a better salesperson, because investment banking, you have to have both the technical side as well as analytical side, as well as the personality to really connect with clients and market the business. And then from there, did my 2 years at Goldman Sachs, I decided, well, I'll go to JP Morgan, because they had a 6-month training program. If you can imagine, that's what Wall Street used to be. And I know you're smiling because I'm sure at Merrill Lynch, they also had a very long training program when you started. Maybe not 6 months, but a good time altogether. And so I went to JP Morgan, and there I felt I really connected with the people. One of my first bosses was on the Reagan-Bush transition team. He was a political appointee, was the head of the Office of Thrift Supervision. And so that's where I was introduced to financial services as an area of opportunity from an investment banking perspective. And I was introduced to capital markets because most of the clients in the government tended to be the Fannie Mae's, the Freddie Macs of the world. And so I picked up new skills in capital markets. And then I was lucky enough to be one of the youngest vice presidents ever at JP Morgan. And my mentor was the head of investment banking, a really gifted banker who I believe still on the board of Yale. And I said, hey, should I go back to business school? That's a common question that people get. And he said to me, well, if your career is working out, JP Morgan, you don't need to go back to business school. Just tell me what you want to do next. And I said, well, hey, I want to get back into technology. I was an engineer at heart. I want to be a tech banker. And this is back at the early days of the internet. But JP Morgan really was banking still the digital equipments, the IBMs of the world. And so the Hotmail, MindSprings hadn't really sunk into the firm yet. And so
I was a tech banker at the start of my career at Merrill,
oh, yeah.
but in New York, not Palo Alto. So similar, the New York East Coast tech was a lot of the hardware, companies making revenue at that time. And the East Coast was all the .coms, which now I guess have exchanged themselves for apps.
Exactly. And, I remember doing the IPO for Alta Vista, if you remember that search engine, and no longer around. Or I did the carve out of Sabre from American Airlines. That's what tech banking was back then. It's not what it is today. And it wasn't a satisfying feeling for me. And I was about ready to quit. I talked to the head of investment banking and I said, hey, I'm really not enjoying what we're doing. I don't know if I really want to move back to the West Coast. But then he said, no, I have someone you should meet. And he introduced me to a super investor. He was running their financial services investing for JP Morgan, Merrill Hardspan. And I'll forever be indebted to both Tom Ketchum, who was my mentor, and Merrill for teaching me about investing and letting me learn. And that's where I learned private equity. And JP Morgan was a general partner along with Marsh McLennan on the very first Trident fund. And that was the very first insurance services fund. And now I think it's maybe Trident 4, and there's multiple billions of dollars under management. But Trident 1 was started off as $667 million that was invested very wisely in insurance services under the auspices of Bob Clements and Jeff Greenberg, legends in the insurance industry. And I learned so much working with these great people. And what I learned was that insurance, although it seems very boring on the outset, financial services, who wants to invest in specialty finance companies? It's a very good place to learn how to make money. And thanks to Merrill, I was able to get the freedom to do my own deals with her guidance, of course. And I learned from her on some of the larger existing deals, and it worked out really well. And when Merrill moved on, she went to Trident itself. I said, hey, I want to try something different. I still like technology. I still like business services. I like the crossover between technology and tech-enabled services. And I liked.
And this was before fintech was a thing, though, I believe, right?
Oh, I was doing fintech before fintech was a word. I was doing payments. I was doing data analytics. I was doing trading systems. I got moved into a group at JP Morgan that was in charge of early stage investing. And we invested in a lot of the things that are around today, like Market Access, multi-billion-dollar company in the fixed income trading business, Archipelago, Capital IQ. And one of my favorite companies, a company called DealerTrack, which turned out to be the largest auto loan processor in North America. Started off with 23 people as a carve-out that we did, and we built it into a multi-million-dollar company that we took public. Fantastic team that we hired and did several acquisitions, was a platform company. But sort of as you go through private equity, as you know, a lot of it is tribal learning. You look at pattern recognition and you see the same things over and over again. And sometimes they change, right? Because new things happen, like technology. And so you have to adjust your investing and your expertise to doing that. And so with this DealerTrack company, I made a lot of good relationships and we had a lot of success. Success is always very good to build friendships, I suppose. And it taught me that, hey, I really enjoyed private equity and I'm glad I stayed. And JP Morgan at the time was undergoing many different mergers. As you may recall, JP Morgan merged with Chase, which then merged with Bank One. And so JP Morgan Partners, which is where my private equity unit became, we became CCMP Capital after we were spun out of JP Morgan. And I noticed there that we were doing bigger and bigger deals. JP Morgan Partners had a $6.2 billion fund in the early 2000s, which was unheard of. It was, probably the only fund bigger than that was Tom Lee's fund. And people were doing club deals. And my boss at the time, Steve Murray, said, hey, if you're not investing $200 million, and I don't care if you do it in a club deal or not, but you got to invest a lot of capital. I remember we were working on a deal in the mortgage servicing space. And this was in the 2006, 2007 timeframe. And it was a very good team. And we were going to do a carve out of another bank's operations. But we could only deploy maybe $100 million of capital initially. Steve told me, sorry, that doesn't make sense. We can't do that. And I said, well, there are good returns potentially here. And he's like, no, we really need to deploy more capital. I understood the business model. So I said to Steve, hey, maybe I should go and look at something else. And so I looked around and I joined Arsenal Capital. Arsenal Capital at the time was managing about $400, $500 million. Fund 2 was like $300 million. And I came in to lead the business services, financial services team. and it was a very good match. I enjoyed working with the team. I learned about operating partners. I think Terry Mullen, who founded the firm with Jeff Kovac, was sort of a visionary, and he saw that having operating directors and operating partners with industry backgrounds was a very good thing to have. And he also saw the advantage of having business development partners, things which people think of today as probably standard for most funds, having these types of resources available. He was thinking about years ago. And he really put a lot of process, I think, into both, not just the fundraising of things, but the actual both investing side of things as well as the operating side of things. And that was a great experience. And then, as you mentioned, having a good run at Arsenal, we decided to form ClearPoint. Can't believe it's been 9 years, probably a little less than that. But at the time, I think that we thought about raising a fund. And before jumping in wholeheartedly into this, we did a lot of diligence. I talked to a lot of other GPs. And we tried to figure out, okay, what part of the market do we want to do? And it was very obvious to us that the lower middle market had changed. And most people were thinking the lower middle market being companies of enterprise value of, in our minds, maybe 20 to 200 million, but people kept wanting to deploy more and more capital. So those smaller deals were the ones that were being underserved. And especially in the business services and financial processing sectors. In consumer retail, we saw that there are a lot of people who look at smaller companies. But in our sectors, if we could deploy both the industry operating resources as well as our private equity experience, we thought we would have a competitive advantage in doing that. And so my business partner and co-founder, Ingrid Mazul, she and I had worked together at JP Morgan. And after CC&P Capital, she went to HIG Capital, which is probably the most dominant player in the lower middle market and the most successful player in there. She has a terrific track record of investing, not just from her JP Morgan days, but from her HIG days. She said, hey, this is just an excellent opportunity, and we should do this on our own. And so, as I mentioned, we talked to a bunch of GPs. We also talked to a bunch of LPs. And we noticed that the LP conversations always came back to deals. Hey, what deals do you have for me? And we said, well, hey, don't you want to talk about the firm? And let's talk about funding ClearPoint. But they only want to talk about deals. And so as we were going through this, we then started gathering commitments, and we realized that, okay, a first-time fund, and people still want us to do deals, but a lot of people want to take our economics on these first few deals or in the first-time fund. And we said, hey, that doesn't make sense. We don't need to do 10 or 20 deals as ClearPoint. And we came up with the idea of doing this as an independent sponsor, having talked to other successful independent sponsors in the market. And we asked them, okay, how did you do the organization of your firm? How many employees do you have? What's your back office? Who does your insurance? Who does your accounting work?
You were talking about the operations of the business, and you mentioned at Arsenal, the founders there had a clear sense of business building. And if you go even further back to at JP Morgan, where private equity started was at these large firms, often captive inside of banks, and you didn't have to think about the operations, right? You thought about just investing, and when people left, they thought of themselves as investors. I started a PE firm. I'm an investor, right? And that's a mistake. Right? When you start a fund, you are an entrepreneur and you are building a business. And if you don't think about all those things, then that's where often the failures happen. Exactly. But it's interesting that even the LPs weren't getting it at that time, because clearly now LP's diligence, right, operating due diligence revolves around the business operations, right, risk management.
Oh yeah, data security. Yeah. So we felt by having good providers, service providers on the administration side, on the operation side, we would be fine. And that turned out to be the case. We had LPs due diligence on us. They asked us, who did we use on our back office? Who do we use? We used LeverPoint. Oh, well, Of course, other firms use them. Arsenal uses them. They must be good. Who do we use for our quality of earnings? Well, we use E&Y and KPMG. Well, check the box. It's not a problem. But yes, people often overlook as they're building a firm that, hey, who's doing your background checks? Who's doing your insurance? Those are things that people actually care about. And LPs do care about that. Even as an independent sponsor, they're asking us the same questions.
Well, the other interesting thing about being an independent sponsor is, as a term, it wasn't, that long ago where it wasn't understood what an independent sponsor was. I'm raising SPVs, or I have a deal sourcing agreement with certain LPs who pay overhead, but aren't committed to investing in deals. There's different ways, different words people use. And if you looked at independent sponsor landscape, it was a mix of highly credible professionals who saw it as a better way to do business, and a mix of individuals who aspired to raise funds but just couldn't yet.
No, you're so right. You're so right.
And the folks who were aspiring to be something else, I think, often missed the opportunity that being an independent sponsor can provide, right? And really leaning into the best that model can be, instead of saying I'm an independent sponsor, but I'm lamenting it and missing the opportunity. They could have been taking a different perspective. It sounds like that's what you've done. So can you maybe talk about how, obviously you started thinking you might raise a fund. What were the critical things that really said, what, this isn't something we want to do, and we can be really successful and grow a franchise as an independent sponsor?
Well, a lot of things that we heard, the feedback from LPs is they want consistency of strategy, right? And so as an independent sponsor, we can look at both buyouts and recaps, which is our preference, but we can also look at minority growth equity deals. And if you're just limited to one strategy, that could work, or maybe that doesn't work for people. And depending on what you want to accomplish, and for us, we want to generate the highest returns possible for our limiteds. And we want the freedom to look at both. But yet, at the same time, we don't aspire to have $1 billion under management, or that was not a realistic goal as a team of 2 people coming out of quality institutions. But we would have to build a large organization to support that. And I think neither Ingrid nor I wanted to do that. We wanted a small, nimble team to look at great opportunities to create returns for both ourselves and our limiteds, as I mentioned. And so I think the key, one of the key determinants of being an independent sponsor is, yes, you have the freedom to look at that. And B, you also have the freedom of not being pressured to do bad deals. And you don't need to have your LP say to you, hey, you have all these assets under management. Why aren't you deploying the capital? And especially in this environment today that we are in, where capital is plentiful, very good deals are still out there, but prices have accelerated a lot, especially given the fact that leverage is still freely available, even post-pandemic.
Point as well, because a lot of asset managers have committed capital funds don't believe it's their job to time the market, right? If the market says this is evaluations, our job is to deploy capital in certain vintages, right? And obviously, a GP, your capital is getting invested alongside LPs, right? So how much of your own and your partnership capital is more aligned with the interests of your LPs given your investment structure?
No, I think we both align both our deal structures, our compensation structures, very much so with our investors. And I think they appreciate it. If a large family office, for example, has a direct interest or likes a certain industry, and we can help tailor the deal flow that they see in that particular industry. Whereas another family office, for example, may say, hey, I have no interest in real estate at all. And so even though we don't do real estate development, but yet we look at things in the services side of the real estate sector, they don't really have an interest in seeing things like that. And so I think by allowing us to tailor both the solution for the sellers of a business, as well as who we actually have as our limited partners, really makes for a stronger relationship, both with the management teams and the sellers that we still have, as perhaps they're retaining a stake in the business, as well as our investors. Though I do like to say what we do isn't rocket science. You don't need to have a PhD to be an investor. And we're not a life sciences investor, we're not a biotech investor, so we don't need to understand the science behind what we do.
Understanding risk is really important. And I think when you're a professional investor, you probably take some of that for granted a bit. When I first started working in private equity, I remember thinking, okay, we buy these businesses that someone built over 20, 30 years, and in 3 to 5 years, we sell them for 3 times as much, right? Don't those people who sold us the businesses feel bad? They spent 30 years and we spent 5 and we made so much more, right? And now that I've been an entrepreneur, I realize most entrepreneurs don't feel that way, right? Because when they build that business organically, get to a certain level, a lot of entrepreneurs don't want to take the incremental risk. Yes, you can invest more in technology, you can hire salespeople, but all this investment is cash that otherwise comes out of that entrepreneur's pocket, which is why a lot of businesses get to a certain point and just stay. And this is where private equity can create a lot of value, because you might look at such a business and say, okay, we invest capital, there's risk in investing capital, but how much incremental risk is it? If you bring in the right team, right, and you follow, playbooks, there's ways to create value and minimize that risk, but the entrepreneur by themselves may not be able to do it. But that's where I think private equity as a partner can really add value. And it's interesting the way you talk about how you invest, comparing that to what you had at JP Morgan, where $100 million check isn't good enough, right?
I mean, you really see this in the lower middle market. And that's why I love the lower middle market, because many of these businesses are lifestyle businesses for people. They don't want to take that risk. They don't want to make that extra investment in salespeople. They don't want to upgrade their talent. Maybe it's the same team that was there from the very beginning. And some people are good at growing an organization from 0 to 50 million, 100 million in value. And then others are better at scaling a business from that stage. And it's rare to find somebody who can go from the very early stages to a multi-$100 million, billion-dollar company.
I feel like there's 3 distinct types of manager. The startup manager, who works well in that chaotic situation where there's an organization. The growth manager, the guy who can put in processes and institutionalize. And then the very large company manager, which is managing shareholders and egos, right?
Yeah. No.
Even if he is competent at all 3 things, the odds are they have a competitive advantage in one versus another in personal preference, right? You might be a brilliant investor at writing $100, $200 million checks. You just don't like it, right?
Right.
So this is why you see serial entrepreneurs, which is why you see the CEOs that PE guys bring in, build a business, sell it in 5 years, do the next one, right?
And I must admit, most PE investors don't know how to connect to the entrepreneurs. They know how to connect to the sponsor-backed, polished, MBA-driven CEOs, perhaps, because they have similar backgrounds. And look, that's a business model. There are very successful PE investors that way. But in the lower middle market, these are interesting individuals. They don't have to sell their business. They're not part of a fund generally, where perhaps they're at a fund at the end of a fund life. They own this business. Maybe their family's involved with this business. It's very important to them what happens to the people and what happens to their company. And they're willing to entrust their baby to you if you can demonstrate that you have a plan for growth, and at the same time, you have a plan for an exit. Because perhaps in their mind, like you said, they want to take some chips off the table. It's never an all or nothing thing. Many sellers think I have to sell 100%. It's not just a minority deal that's possible, but it's also, hey, you could retain 20 or 30% of a business. And that 20 or 30% could be worth more than when you sold your, 60, 70, 80% to begin with. And I think that's really the art of reading a situation, listening to what people want to accomplish. One of the first things that we ask a seller is, what do you want to accomplish? And we listen and we try to craft the right solution for them.
In the 9 years that you've been operating as an independent sponsor, what are the biggest lessons you've learned in running this type of business?
I think one of the biggest things that we've learned is, never take things for granted, because things will change and you have to be flexible and nimble. You have to think about different solutions for things. An example of that, we had a very successful investment in a data services business called Shore Group Associates. The fastest growing piece of this business, and the most interesting piece, was the pharma healthcare side of things. And we thought as private equity investors that, hey, selling data or selling data services, analytics, we could do it in financial services, we could do it in pharma services. But I think to the credit of the team, they said the biggest way to unlock that value is to carve out the pharma side of things. And we said, okay, well, it's, you know, a good chunk of the company, but it's still losing money at this stage, that on a standalone basis, whereas the whole thing was making money. But we listened to the team, and we actually put this very large business into Y Combinator. And I don't know how many people listening to this are in Silicon Valley or understand the tech side of things. I live personally in the heart of Silicon Valley, but am more familiar with the buyout side, the cash flow side of things. So when I see these VCs out here in Silicon Valley and how they value businesses, I don't really understand it, but hats off to that team. They went to Y Combinator. They got funded by an excellent venture firm, Menlo Ventures, and the business has taken off from there. And I think they're well on their way to being a unicorn. And so you have to be flexible in your thinking, number one. And I think we are blessed when that's the case. Hardest thing, I think, for people as investors is to look at a situation and not, and as I said earlier, we all have pattern recognition. We try to see the same things over and over again. I think the key learning for us was that every situation is unique. I think I learned that from JP Morgan. I still learned that at Arsenal, and I think we learned it at ClearPoint. You have to listen to what the sellers want. And a lot of times people get turned off by private equity firms or private equity executives because they do all the talking and they don't listen to the sellers. You have to listen to what they want and be flexible enough, key learning number one, to figure out what the right solution is for the investment opportunity, because that drives the returns for people. Wall Street and private equity has a very bad reputation sometimes in the entrepreneurial environment. They think of us as cost cutters. They think of us as people that don't care about the individuals. Well, I can tell you in the lower middle market, we care about those people. We listen. And I would highly recommend that anybody who wants to go into the lower middle market retune into these skills. You can run an auction, or William Blair, I should say, can run an auction, or Goldman Sachs can run an auction, and you could be a private equity investor and pay the highest price because you know how to structure things the right way, and you know how to cut costs, and you can bring in your operators to cut the cost. But that's not going to always impress the lower middle market sellers. You have to think as if you were them. And so, two pieces of advice.
Now, your career spanned a couple decades. You know, the young professionals coming into this industry post-pandemic, looking 20 years ahead. What advice would you give someone trying to build a career in financial services? You know, we talked about the work-life balance at the beginning of the conversation. I don't know that we can convince people that, you know, working 4 years worth of work in 2 years, like you and I probably did at the beginning of our careers, is a good idea anymore. But how does one differentiate themselves and compete in what's a competitive world?
Yeah, it's an excellent question. I just gave a lecture at my alma mater at Berkeley. The class was non-traditional careers for engineering students, the freshman class. And I tried to convince them that, hey, it's okay. You can be an engineer and still perhaps go into finance or go into management consulting. But I think that the critical thing is have a good foundation of skills, analytical skills, have a good perspective on things, but also try to build some of the softer skills as well as you go through things. Many people here in Silicon Valley want to join a startup. That's great. That's a great opportunity. But your ability to shift into finance is much harder. I think the traditional career path of going into Wall Street and then going to get your MBA and then getting an internship at a private equity firm or venture capital firm and then joining that firm afterwards, that is still out there. If you choose to go off of that path, just realize it may take a little bit longer. It's not necessarily wrong, or it's not necessarily a harder path. It just may be a longer path. I know some people who have gone into the engineering side, they've gone into industry, they go back, they get a degree, an MBA, and they do make it to the private equity or venture capital side. Perhaps you see it more on the venture capital side than you do on the private equity side.
I very much wanted to be an engineer growing up. I got a pilot's license when I was a teenager, thinking I would do aeronautical engineer. I'd applied to Berkeley and gotten in. But in the last minute, I did an internship at a software company. And this was before tech was cool. And it was a bunch of stodgy old people in coast not talking to each other. I'm like, oh, I could never do this. So, I thought,
Right.
okay, if I want to be in business, I have to study this. I didn't know that I could study one thing and do something else, right? And today at TrustVista, probably half our recruits are from an engineering background. I have a philosophy: you can hire bright people and teach them finance. You can't hire finance people and teach them to be bright. So,
Yeah.
but it is
No.
a long journey, as you said, and everyone's trying to get there quickly. But the time does pass, and the people who can have a view towards the future and let their skills compound, I think ultimately are going to be the ones who are going to be most successful. And this idea of compounding, I really believe it applies to individuals' lives and careers as well. But the smartest finance professionals often don't seem to grasp how compounding can happen for the individual. They see the startup that gets that $1 billion valuation, and they want that too, right?
I think you're right. The idea of compounding is one where I think younger people don't have as much patience as we do, or as they should perhaps going forward. I would say, look,
is this a generational thing, or is it just, did I really have that much patience when I was younger, or was the situation just forced me to be, patient, right?
I don't know. I think it depends on your situation and what you grew up culturally. So as I was saying, I think it's a generational thing, and I try to teach my kids to be hungry. And I think that is a common problem when you have kids who live in a bubble, and I think we do live in a bubble in places like New York City and in Silicon Valley. I think it's important to be hungry and to want to drive yourself to success, whether that be something entrepreneurial, whether it be on the corporate side. That's just general advice. Nothing comes easy. And I think people hear about all these great startups and whatnot in Silicon Valley here. There are a lot of failures too. Only way you can recover is you pick yourself up, learn from your mistakes, and just keep going.
Well, Carty, it's been such a pleasure speaking with you, and thank you so much for sharing your thoughts. It's been our privilege to be your partner, and we look forward to continue working with you in the years ahead.
No, we've had an excellent experience with TrustVista. I think, as I perhaps mentioned earlier on in our conversation, I realized maybe we should have hired you guys many years ago. The team is wonderful, extremely responsive, and as an independent sponsor, I think you should be having a firm like TrustVista supporting you. The model works, and when you have the quality of what you're getting, it really makes a huge difference. Gives us a lot more, we can cover a lot more ground thanks to TrustVista.
Well, I appreciate you saying that, and certainly it's, like I said, it's been our privilege to be your partner as well. Thank you so much, Carty, and thank you for the audience for listening in today.
Great, thanks so much.